Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll begin with Accounting Chapter 6, Unit 2, that is Sales of Goods on Approval or Return Basis. So let us begin. This is lecture number 1. From the chapter Accounting for Special Transactions, we are beginning with Unit 2, that is Sales of Goods on Approval or Return Basis. Let us begin with the learning outcomes. After studying this unit, you will be able to understand the nature of goods sent on approval or return basis. You will learn the accounting treatment of sale on approval or return basis under different situations. Overview of the unit. Sales of goods on approval or return basis. Accounting treatment when the business send goods casually, frequently, or numerously. So this happen like many a times it happens that there are some of the organization which depends upon such kind of transactions. So they transact casually means a very low level of sales are like that. So transactions is treated as ordinary sales, like we pass the journal entry for the ordinary sales. In the same manner, the transactions are treated in the same manner in case of casually. But if the business sends goods frequently, then sale or return journal is prepared with 4 main columns: goods sent on approval, goods returned, goods approved, and at last the balance column. If the business sends good numerously, then sale or return day book and sale and ledger return ledger is prepared. Supposingly, sale or return day book is prepared for 3 months, so after 3 months the ledger is prepared, treated as a memorandum books, treated as a temporary books. Memorandum books in the sense what? Whatever transaction is recorded in the memorandum books, the effect will not be seen in the income statement or statement of financial position, P&L and balance sheet. Okay, let's continue. Introduction. Under normal course of business, goods sold to customers is treated as sale immediately when the goods are sold, with corresponding revenue from such sale being recognized in the profit and loss account. However, when a businessman wants to increase his sales or introduce a new product in the market, he usually faces hardship due to the competition prevailing in the market. To encounter it, goods are sometimes sent to the customer on sale or return basis. Here, goods sent on approval or on return basis means goods are delivered to the customer with the option to retain or return them within a specified period of time. Generally, these transactions take place between a manufacturer or a wholesaler and the retailer. In current scenario, this place is prevalent in case of online sales where the buyer is given time of few days to return the goods if the buyer believes that the specification of goods are different from the same mentioned above and mentioned before and website at the time of sales. There may be certain terms and conditions to administer the return of goods. Following are the essential the features of sale of goods on approval or return basis. There is a change in the possession of goods from one person to another. Change in the possession of goods from one person to another. It does not involve transfer of ownership of goods, just the possession, just there is a change in the possession. The ownership is passed only when the buyer gives his approval or if the goods are not returned within a specified period of time. Supposingly the seller had given the goods to the buyer on sale or return basis for 15 days. Till 15 days, the seller will wait, but if there is no confirmation from the buyer side, in that case after 15 days the seller will record this entry as sale. C. The customer does not incur any liability when the goods are merely sent to him. In case of online transactions, sometimes customers are given choice to pay on receipt of goods. In some cases, they are required to pay in advance also, and then the seller ships the goods to the buyer. Even in case of buyer has paid in advance, it retains the right of refund if the goods are returned as per the terms and conditions agreed between the seller and the buyer. As per the definition given under the Sales of Goods Act 1930, in respect of such goods, the sale will take place on the property in the goods passed to the buyer first, when he signifies his approval or acceptance to the seller that yes, I am accepting the goods, I want to buy this goods, or when he does not some act adopting the transaction, when he does some act adopting the transaction. This could be he does not tell to the seller that yes, I am accepting the good, but he is using the goods for his purpose, or he has already sold the goods. In that case, he had accepted the goods. Third, if he does not signify his approval or acceptance to the seller but retain the goods without giving notice of rejection on the expiry of specified time, if a time has been fixed, or on the expiry of reasonable time if no time has been fixed. I believe you understood till here. Let us continue. Kindly do the notings. Delivery of goods to the buyer with the condition to retain or return the goods within specific period is sale of goods on approval or return basis. Only physical possession is transferred. Ownership is not transferred. I believe you understood till here. Buyer shall become owner of goods when buyer gives approval, that is, he accepts the goods, or buyer does not buyer does not return the goods within the specified period within the specified period. I believe you understood. Let us continue. Accounting records. Accounting entities depend on the fact whether the business sends good on sale or return basis casually, frequently, or numerously. We need to learn all the three cases, starting with the first case, that is casually. When the business sends goods casually on sale or return basis, when the transactions are few, the seller or sending the goods treats them as an ordinary sale. If the goods are accepted or not returned on, the business receives no intimation within the specified time limit. No extra entry is required to be passed because the entry for sale, that is passed at the time of sending the goods, becomes the usual entry after the expiry of specified time. If the goods are returned within a specified time limit, a revised entry is passed to cancel the previous transactions. If at the year end goods are still lying with the customer and specified time limit is yet to expire, the entry for sale made earlier needs to be cancelled. The value of goods lying with the customer must be reduced from the selling price to the cost price and treated as ordinary inventory for business for balance sheet purposes. Supposingly, what happened that you made a sale on 15th of uh, 15th of March, and the time limit given is 30 days or sale or return basis. Now, the books of accounts closes on 31st March year end, and still there is a 15 days time remaining from 1st of April to 15th of April to the customers to give the consent for acceptance. In that case, we need to reverse the entry that we have passed on 15th of March, that data to sales, and we need to reverse this entry on 31st of March. Sales account would be debited and debtors will be credited. I believe you understood. Let's continue. Journal entries. When goods are sent on sale or return basis, customer's account would be debited to sales account. Next, with the invoice price. Next, when goods are rejected or returned within a specified time period, when the goods are rejected or returned within a specified time period, sale or return inward account will be debited and customer's account will be credited because it is returned or rejected. So entry would also be reversed. When goods are accepted at invoice price, no entry. Fourth, when goods are accepted at a higher price than invoice price, usually it didn't happen, but still customer's account needs to be debited to sales account with difference in price, with the difference in higher price. Next, when goods are accepted at a lower price than the invoice price, it should be reversed. Sale account will be debited and customer's account will be credited with the difference in price, lower price, difference in lower price. Next, at the year end, when goods are lying with the customer and the specified time limit is yet to expire, the time limit has not expired, still few days are left. We need to reverse the entry passed earlier. So sales account will be debited to customer's account. And if these goods should be considered as inventories, with customers, and in addition to the above, the following adjustment entry need to be passed. Inventory with the customer on sale or return basis, debit to trading account, cost price or market price, whichever is less. No entry is passed for goods returned by the customers on subsequent date. I believe you understood till here. I believe you understood till here. Question 1. On 31st December 2009, goods sold at a sale price of 30,000 were lying with customer Mohan, to whom these goods were sold on approval or return basis and recorded as actual sales. So it is recorded as actual sales. That means this is a casualty transaction. Goods sent or return basis casually first. Since no consent was received from Mohan, the adjustment entry was made, presuming goods were sent on approval basis at a profit plus 20%, profit of cost plus 20%. In the balance sheet, the stock with customer's account will be shown at what figure? So, solution. Cost is 100, selling price is 120, profit is 20. This is cost, this is sales. Over here, the sale value is 30,000. What would be the cost? So, 30,000 multiplied by 100 divide by 120. Solve it. Rupee 25,000. Cost 100, sales 120. Sales is 30,000. What would be the cost in the books? 25,000. Question 2. A sent some goods costing 3,500 at a profit of 25% on sales to B on sale or return basis. B returned the goods costing 800. At the end of the accounting period, that is on 31st December 2005, the remaining goods were approved by him. The stock on approval will be shown in the balance sheet at what value? Solution. So A sent goods to B. What is the cost of the good? 3,500, and profit percentage 25% on sales. 800, the value of 800 goods is returned. 3,500 minus 800. The stock on approval will be shown in the balance sheet. So it is 3,500 minus 800, which is 2,700. The cost is given over here. This is also cost. So 3,500 is cost. So total 2,700. Next, third question. A sent goods to B on sale or return basis at cost plus 33.33%, 1 by 3. At the year end, time limit to return goods has not expired and B has in stock goods value 20,000, gives journal entries. Solution. A sent goods to B on cost plus 33.33%. The value of the goods at B is 20,000. So this is including the profit. Journal entries. Sales account debit to debtors 20,000. And one more entry happens at year end because the time has not expired. So entry for reversal and one more entry. Stock with customer. Stock with customer on sale or return basis 15,000. Debit 15,000 to trading account. To trading account 15,000. How we calculated this? How we calculated this 15,000? 20,000 multiplied by 100 divided by 133.33. We had eliminated the profit element, so at cost we have recorded. I believe you understood. Let us continue. Next question, question 4. A retailer has credit certain items of sales on approval basis rupees 60,000 to sales account. Of these, goods value 16,000 has been returned. So out of the 60,000, 16,000 is returned and taken into stock at a cost of 8,000. Though the record of return was omitted in the books, in respect of the another parcel of 12,000, cost being 6,000, the period of approval did not expire on the closing date. Cost of goods lying with the customer should be what? So out of this 12,000, the cost is to be removed. So cost being 6,000. Answer 6,000. Cost of goods lying with the customer should be 6,000. So this was good are sent casually. We have learned. Now another aspect, when the business send goods frequently on sale or return basis. When a business sends goods on sale or return basis on a frequent basis, an immediate sale does not take place. Only when the customer signifies his intention to purchase the goods or take some action whereby it is indicated that he has decided to purchase the goods, the property in the goods passes to the buyer. So long as the property does not pass to the buyer, the seller does not record it as sale and therefore does not debit the customer with the sale price. Under this method, record of goods sent is maintained in a specifically ruled sale or return journal daybook instead of passing the entry for sales of goods. This daybook is divided into 4 main columns: goods sent on approval, goods return, goods approved, and balance. I believe you understood. Let's see the format. Goods sent on approval, goods returned, approved, and balance at last. When such a journal is kept, the following procedure is adopted for recording transactions entered into on this basis. When goods are sent out of the sale or return or approval, entries are made only in column 1st to 4. The sale price of goods being entered in the column 4. The sale price is also posted to the debit of the customer's account in goods on approval ledger, and periodically total of column 4 is posted on the credit of goods on approval total account in the same ledger. If goods are returned, entries are made in column 5 to 8. The price of goods returned being entered in column 8, the individual amounts are credited to the customer's accounts in the goods on approval ledger, and the total of this column is periodically posted to the total goods on approval account. If the goods are retained by the customer, entries are made in the column 9 to 12. The individual amounts are then posted in the debit of the customer's account in the sales ledger, and the total of credited to sales account in the general ledger. Further, the customers on account of the goods on approval basis are credited with the individual amounts of goods sold, and periodically the total of amount is posted to the debit of goods on approval total account. The value of the goods sent out but not sold or returned till the close of the year is extended to column 13. The total of the column afterward will show the value of goods with customers at the sale price. The balance amount is calculated as follows. Balance value of goods sent on sale or return basis less value of goods returned less value of goods approved. So balance is calculated on value of goods sent on sale or return basis less goods returned less goods approved. Information relating to goods delivered and goods returned is kept on memorandum basis, temporary basis. However, information relating to the goods approved and balance is duly accounted for, passing journal entries related to sales and inventories on approval basis. The amount after eliminating the element of profit is included in the trading account representing the value of inventories with customers at cost price. Like an ordinary closing inventory, such goods are considered as inventories lying with customers on behalf of the seller, and the value of cost or NRV, whichever is less. At the time of approval, debtors account to sales, customers account to sales. At the time of preparing the final accounts, an adjustment entry is required for balance goods such which is as follows: goods with customers on return, on sale or return account to trading account. This we have learned. Next question, question 5. Umesh sends goods on approval basis as follows. Date in the month of January 2010. Customer's name, sales price of goods sent, goods accepted and goods returned. The date is given 8 January. Anna, the customer's name is Anna. Sales price of goods sent 3,500, accepted 3,000, returned 500. So what is the balance? Nil, nothing. Babu on 10th January, goods sent 2,500, accepted 2,500, balance is nil. On 15th January, Chandra, goods sent 3,680, returned 3,680, so balance is nil. Desai on 22nd January, goods sent 1200, accepted 1000 and returned 1260, so balance is nothing. The stock of goods sent on approval basis on 31st January will be nil. No stock. In the balance column, everything is nil. Next question, question 6. Which of the following is not a main column of sale or journal or return journal? A. Goods sent on approval column. B. Goods return column. C. Goods approved column. Or D. Purchase column. Answer is D. Purchase column. Answer is D. Purchase column. Let's continue the last concept of the chapter, and that is when the business sends good numerously on sale or return basis. So when transactions are numerous, a business maintains the following books: sale or return day book, sale or return ledger. Ledger contains the account of customers and the sale or return total account. Daybook is a primary book which records all the transactions, and from there these are entered in the sales or return total account. It is important to remember that both are memorandum books. These records are not a part of regular books accounts. The following procedure is adopted for recording the transactions under this method. When goods are sent to the customer on sale or return basis, they are first recorded in sale or return day book. Thereafter, the sale or return ledger, all the customers are individually debited and sale or return account is credited with the periodical total of the sale or return day book. Next, when goods are returned by the customer within the specified period of time, they are recorded initially in the sale or return day book. Thereafter, the sale or return ledger, the sale or return account is debited with the periodical total of the sale or return day book, and the individual customers is credited. The above mentioned records are all memorandum and hence cannot find place in the regular books like profit and loss account and the balance sheet. When the business receives information about the acceptance of goods or no intimation is received within the specified time, they are recognized as sales and are recorded in the sales day book. Periodically, the total of sales day book is credited to sales account and debited to individual customers account. To cancel the earlier entries, individual customers are credited and the sales return account is debited. The entries of approval goods are shown below. In the memorandum sales or return ledger, sales or return account will be debited to individual customers account, and in the regular general ledger, individual customers account debited to sales account. At the year end, in the sale or return base ledger, the sum of debit balances to the individual customer's account must equal to the credit balance of sale or return account. It represents the inventories with customers waiting for approval at invoice price. To adjust the cost of such goods with customers in the final account, the following entry is passed: inventory with customer on sale or return account to trading account, cost or NRV, whichever is lower. In short, under this method, entries are passed in the regular books of account only at the time of sale or a year end if the inventory is still lying with the customer pending approval. I believe you understood. Let us continue. Question 7. X supplied goods on sale or return basis to customers, the particulars of which are as under. Date of dispatch is given over here, party's name, amount, and some remarks are there. So on 10th December 2005, ABC Company Limited, the amount is 10,000, no information till 31st December 2005, and so on. Goods are to be returned within 15 days from the date of dispatch, failing which it will be treated as sales. The books of Excess closed on 31st December 2005. Prepare the following accounts in the books of X. First, goods on sale or return, sold and return day books, and another account is goods on sale or return, the total accounts. Let us begin. Solution. Solution. Prepare sale or return day book. Sale or return day book. Date. Party. Goods sent. Goods sold. Goods returned. And balance. Date is 10th December 2005. Copy all the dates first. Dates, amount, and party's name. Copy quickly. The total goods sent is 77,000. Now read the instructions. No information till 31st December 2015. No information. So if no information is there, we will treat it as sales. Next, returned on 16/12/2005. The goods is returned. Okay. So balance is nil over here also. Third, goods worth 2000 return or 20/12. Return is 2000 and no information is there. So 10,000 would be treated as sales. The balance is nil. Fourth, goods retained on 24th December. Retained, then it would be treated as sales. Next, fifth, goods retained on 28th December treated as sales. And last, no information till 31st December. So no information till 31st December. It would be treated as balance because the time is still there. 15 days it's not happened. Let's do a quick total of sales and return and balance. Sales total 47, return is 15 plus 2 17, and it is over here 13,000. So this was sale or return day book. The next account is sale or return total account we need to prepare. Sale or return total account. Particulars amount, particulars amount, particular, this is ledger, so particular amount, particulars amount. First will be recording sales over here. So we'll write to customer sales. Sales value is 47,000. Then returned to customer return. Return is 17,000. Then we'll record goods sent on approval by customer, in bracket write goods sent on approval 77,000, 77,000 total, minus these two figure 47,000 and minus 17,000, to balance carried down, to balance carried down 13,000. This is balance, last column. I believe you understood this. I believe you understood this. So we have completed unit 2 over here. Chapter 6 unit 2. We are stopping here. We'll continue from here in the next class. We'll be continuing in the next class. Thank you. Thank you.